The other day I was chatting with a friend of mine who is well versed with investing in real estate. And then it dawned upon me that he has no idea about how to invest in real estate debt. He only knew about investing in equity. So I thought, I should write something or I should record something where people will understand there is such an avenue, there is such a thing called debt investing. Now, what is debt investing? Investing in real estate debt simply means putting your money into loans secured by real estate rather than buying properties yourself. So in simple terms, you become the lender, like a bank, instead of you become the owner of the property. In most real estate transactions, you have three parties, right? You have the owner, the equity, who owns the equity, the bank who lends the money, and then the person who actually sells the property. But it's different. It's different for the equity because this can provide you steady interest income, just like bank gets, and it has different kinds of risks and considerations. So in this particular episode, we're going to explain you what real estate debt investing is and how it compares with the equity investing, and outline practical ways for you to get started with the US market. We'll also cover the risk involved you should know as a beginner. All right, so first is debt versus equity. What are the key differences between debt investing versus equity investing? So number one is your role. In debt investment, you are the lender. You provide loan to a property owner or investor and receive interest payments. You do not own the property. Instead, you hold something known as lien, or simply put, claim, against the real estate as a collateral. Now, in equity investment, you're the owner and you share the profit or losses. Whereas debt investors are hands-off. They're not dealing with your tenants, they're not doing repairs. Where equity investors have ownership responsibilities, so they're going to deal with everything that comes with property ownership. Number two, risk and priority in the capital stack. So real estate debt is generally considered lower risk than equity because of its seniority. What it means is that the debt holders generally get paid first. They have a legal right to be paid back before equity holders. So if a borrower defaults on the property, debt investors can recover their principal before equity investors can see any return. Equity investors generally last in line, meaning if the project fails, they could lose their entire investment. So this priority makes debt safer, but it also means there's no ownership upside. That means you can't really benefit from the value increase of the real estate. So let's see third, which is return potential, fixed versus variable. So debt investments offer fixed returns in the form of interest payments, right? Your profit is typically capped at loan's interest rate. For example, if you invest in a mortgage note yielding 8% per year, that's generally the maximum you will earn. Aside from the fees and penalties that the borrower might pay. But in contrast, equity investment has variable returns. As an owner, you could earn much more if the property value soars or the business plan exceeds the expectations. But you could also earn nothing or even incur losses. There's no cap on equity upside, but there's also no guaranteed return. So debt investors sacrifice the big upside in exchange for more certainty. And hence, my next point, which is cash flow predictability. So real estate debt usually provides consistent cash flow. Loans have set interest rates and payment schedules, so you can expect a regular monthly or quarterly interest payments, assuming your borrower pays on time. And it's less predictable. I mean, it depends on property. The equity cash flow is less predictable. It depends on property performance. Rents can fluctuate, expenses may rise. Sometimes equity investors might not even receive any cash flow. It is not uncommon. Whereas the debt deals, you just pay as you go. Now, again, and one more difference is volatility and time horizon. Because the debt returns are fixed and secured by collateral, they tend to be less volatile. The value of the loan doesn't swing as wildly with the market conditions. Well, I'll argue that real estate in general is not as volatile as some of the other asset classes. But equity values can be volatile. And property values can go up and down. Additionally, if your debt investment is relatively short term, for example, a loan might be 6 to 24 months in length, then for a fix and flip project. Equity investment often requires longer commitment, 5 to 7 years, or even 3 to 7 years, before you see a full return. That means debt can offer quicker liquidity, whereas equity can, tie up your money a little bit longer. Again, if you offer long-term debt, then it's a different story. Now, control and obligations. Well, as a debt investor, you generally have no control over property decisions. You're not the one who's managing and improving real estate. Your concern is that the borrower pays you back. So they can do whatever they want as long as they are paying you back every month. I mean, equity investors, on the other hand, can have to take active management role, and they may even face capital calls. I mean, they might raise more money if need arises. So in short, equity involves ownership duties and potentially more headaches, but debt is more set and forget position once the loan is made. Now, you might think that, oh, this is great, and I would actually invest in real estate debt. Then how do I do that? Like, what are some really practical ways of investing in real estate debt? All right, so let's talk about it. So one way to do that is something known as mortgage note investing. And note investing refers to buying existing mortgage loans as an investment. So you can buy an entire note. Essentially, you step into the shoes of a bank or a lender. And you might purchase a mortgage note from a lender, and then the borrower starts sending you their monthly mortgage payment. That's a great way to earn passive income in real estate without owning a property directly. By the way, there's a whole book on it if you want to read it. It's written by a person called Dave Van Horn, and the name of the book is Real Estate Note Investing, and it's published by Bigger Pocket Publishing. So another thing is there's a bunch of peer-to-peer lending platforms, right? There's a prosper.com, there's Lending Club. They kind of pioneered this place. But Prosper and Lending Club are more personal loans. They might be in the real estate space, but they're not like a mortgage-backed loans. I mean, they're not like a property-backed loan. There's usually unsecured loans. But then there's a company called Ground Floor that will offer more real estate loan. like a house flip loan. And there's a realty mogul, equity mogul. They'll offer debt investments, equity multiple, sorry, realty mogul or equity multiple. And these are commercial property loans, but they are backed by, the real estate. But you might be required to be an accredited investor if you want to invest in realty mogul or equity multiples. So just keep that in mind. So yeah, these are the platforms you can go to, investigate, and maybe invest. So Prosper.com, Lending Club, Ground Floor, Realty Mogul, Equity Multiple. Again, this is not an exhaustive list. These are some of the platforms available. The next one is private lending and real estate syndications. Right? There's a lot of private lending deals. There is syndicated real estate offerings. And by the way, syndication doesn't just mean equity ownership. There are many syndicators who will put out a loan offering as well. So that's another way to do it. It's sometimes also called a hard money loan. Then there are debt funds, I mean, this is Dave Van Horn, who wrote the note investing book, right? He owns, or he's a partner in this company called PPR Capital Management. And they operate funds that pool investor money to buy a diversified portfolio of mortgage notes. So each of these approaches, whether it's P2P platform, private loans, funds, they will provide a pathway into real estate debt investing. You don't have to choose just one. Many people diversify across all of these. And all of these can be easily discoverable on the internet. Just go on the internet and, look at these websites. And if you want, invest in it. Now let's consider what are some of the risks in investing in real estate debt. Well, first, and the biggest risk is borrower default list. The borrower simply stop paying, then you need to pursue regular legal remedies like foreclosure, right? And there's no guarantee you'll recover everything. For example, if the property value doesn't cover the remaining balance, let's say you lent $150,000 and the market has dropped and the property is poorly maintained and selling might bring on the $130,000. So you're going to incur $20,000 loss. Of course, due diligence, conservative underwriting, lower loan to value ratios will build some sort of cushion. Then the second risk is real estate market downturn. Well, even though you're investing in debt, you're still tied to the real estate market. The property values fall, the collateral securing your loan is worth less. Now imagine if that borrower defaults, then because the market has fallen and the collateral is less worth, you're going to suffer the consequences. So again, it's the same thing as earlier. Just lend conservatively, have low LTV ratios, right, and diversify across different loans, different regions. There's interest rate risk. Now they're sensitive to the real estate debt investments are sensitive to interest rate risk from a couple of ways. One is that if you invest in a fixed rate loan, say 8%, and the market interest rate rises significantly, well, your money is tied at 8%. You can't just withdraw it and deploy at 10%. Right? And then if the rates fall and the buyer refinances, then you have to then deploy that money at a lower interest rate. You don't have a choice. So reinvestment risk these are the two ways of interest rate risk in it. Then the next risk is illiquidity. Real estate debt investments are often illiquid. That means you can't easily sell or exit your investment before it matures. If you buy a mortgage note or invest in a loan, you're usually committed to that loan's term. Now, some crowdfunding platform may have your secondary market or redemption programs, but I can guarantee you that in those cases, you're going to play a discount. They're going to demand a discount, and that means you're going to get less return. They're going to give you less than what the balance of the loan is. Then again, it's platform or sponsor risk. You invest through the online platform or a syndicator. So what you're doing essentially is there's some degree of trust in that middleman. That platform essentially vet deals, handle paperwork, forward payments to you. But if they were to mismanage funds or go out of business, it could impact your investment. And there has been cases where some P2P lending platforms in the past have been shut down or encountered legal issues, potentially leaving investors in the limbo. So, no, it doesn't happen that often, but this risk is out there. I really want to emphasize here, okay? I don't want to scare you out of this, right? But just remember that these are different risks than equity, right? Whether it's lower or not, it's your judgment call. But I mean, this is a different risk than the equity investment. Now, you're protected by being first in the line, but you may still not recover all of your money. Well, good news is that if you get good at it, follow the best practices, have lower LTVs, then your risk can be managed. So in conclusion, investing in real estate debt is about earning a steady interest-based returns with the backing of real property collateral. It offers an alternative way to profit from real estate without becoming a landlord. So it's a passive way of earning money. For beginner investors, it can provide diversification and income. But it's important to approach it with some diligence. You would any investment. But your homework on each opportunity, and over time, you can grow your portfolio of debt investment that generate passive income for you. Remember, you're stepping into a role of the bank. So think like a cautious banker. Protect your downside, know your borrower, and make sure the asset or the property is something you would be comfortable lending against. With that mindset, real estate debt investing can be rewarding addition to your financial journey. Thank you very much. And I hope you learned something new today about real estate debt investing. Again, if you are interested in discussing this more, please contact me. Go to oldmoneycapital.com and there's a contact form. Or you can also email me at vp@oldmoneycapital.com. Thank you.